Hi, this is Dr. Patty Hatfield, and I'm here to talk to you about financial analysis, but in this session we're going to talk about things that are important in financial analysis that go beyond the numbers. So we know the numbers are very important, and as well as the financial notes that we see in the annual reports. But there's some other factors when we're trying to determine the health of a company that we want to consider. And so that's what this video is going to be about. And we'll also look at some sources of information. First of all, you should know what the company's business model is. When you read a company's annual report, you want to know exactly how they are making their money and what drives their profits. So here are some logos from some famous companies, and we can go through and talk about the different ways these companies make their money. For example, we have Starbucks coffee. I think everybody's familiar with Starbucks coffee, but we know that their business model is that they have a whole lot of corporate-owned coffee shops, and by selling coffee both made and also coffee beans that you can buy in packages, that's how they make the majority of their money. They do sell a few franchises as well, but most of their stores are corporate owned, as opposed to, like, say, Dunkin' Donuts, who tends to sell everything in terms of franchises. They don't own, the corporate headquarters does not own any of the Dunkin' Donuts shops, so they're just strictly there for franchising. So very different business model than Starbucks. I've got Ford on there as well. I chose Ford because Ford has a couple of ways they make money. Obviously, they manufacture and sell cars, but they also have their own financing arm. And so when a company has their own financing arm, they do have to disclose those numbers separately or actually the key accounts separately in their statements. But Ford makes its money through both the sale of automobiles and the financing of automobiles. Moving over to YouTube, which is owned by Google. And we know that they make their money, Google makes their money a variety of ways. Specifically, YouTube makes their money by selling ads. Google makes most of their money by selling information on you. So you're their product. They keep track of what you search for and sell that information to other companies. So that's how if you're looking for a camera one day and all of a sudden the next day you look and you've got all these cameras from different stores popping up on your screen, Google helped them get that information. Google's also into cable TV now, so they are making money there. They're in most major cities. So there's a variety of ways that Google makes their money. Down below Ford there, we've got Consumer Reports. I picked a nonprofit. I like Consumer Reports because they do not make their money from advertising dollars. They only accept donations, and they make money through online and magazine subscriptions. So as a result, people tend to trust their recommendations more since they're not swayed by advertising dollars. And then finally, there's Netflix. And Netflix, of course, as we all know, started out as being really beating Blockbuster in DVD rentals. And you would mail them back and forth. They would mail you the DVD rental and then you would mail it back within a few days. And that's how Netflix started out with their business model, but it has evolved over time. And that's the thing you want to look at, is how has the business model evolved. And so unlike Blockbuster, Blockbuster went under because they didn't evolve appropriately. Netflix did, and even though they still do the DVDs, they also do streaming, which is more popular, and now they've gotten into creating their own shows that are exclusive to Netflix, many of which are very, very popular. So when you read an annual report, like I said, you should know exactly what the business model is. And I love this quote by Warren Buffett that says that there's all kinds of businesses that Charlie, that's his investment buddy, Charlie and I don't understand, but that doesn't keep us up at all, or doesn't keep us up all night. It just means we go on to the next, and that's what the individual investor should do. So his philosophy is, if I don't understand everything I need to understand about that company by reading the annual report, then I move on. And I wholeheartedly agree with that. Transparency is very important. Another thing you want to try to assess is how good is the management. And one way you can do this is you certainly want to read the management discussion and analysis in the annual report that's written by management, and that will kind of give you an idea of how on top of things management is. Also, I don't have it on here, but the letter to the shareholders would also be good. I like to listen to the CEO and CFO conference calls with analysts on the internet, and you can find them there at the website I have posted. And then listening to management answer questions from the analyst gives you really a lot of insight of how they can defend poor numbers and how do they expect to come back around. Keep in mind, when you're listening to the conference calls with analysts, you may hear, or you will hear, some forecasting. And in the annual report, the only part of the annual report that is allowed to include some forecasting material is the management discussion and analysis. Everything else has to be historical. So that's why the management discussion and analysis is highlighted here. Also, it's good to look at ownership and insider sales, because obviously executives and large stockholders are going to, they've got inside information. So if you see them selling off a lot of stock all of a sudden, that might be a red flag that something's awry. And then past performance doesn't ensure future performance, but still it gives you an indication of the management team and how well they work together and how well they manage the organization. So you can look at their past performance and see how well they've done. Other things to keep in mind: if a company is very dependent on one large customer, that's a risk. That puts that company at a much higher risk. And then I have a general rule of thumb. Ideally, the largest customer should not make up more than 10 to 15% of the total revenues of the company. And the reason being is, if you have a large customer like that, it gives them a lot of power to negotiate. The obvious example here is Walmart. Walmart is a large customer for, in fact, we'll talk about that a little bit more later, but they're a large customer for many different companies, and as a result, they have incredible buying power. And then the other downside to having a large customer, if your large customer goes bankrupt, then you can go bankrupt too. So a lot of times suppliers for large manufacturing firms, that would be a good example. If that manufacturing firm doesn't even have to go bankrupt, if they hit hard times and they have to start laying people off, they'll cut back on supplies, and a lot of times suppliers will end up going bankrupt because they were so dependent on that one customer. Other questions to consider: To what extent are the company's revenues tied to a single product? So, the general rule of thumb is you don't want to be tied to a single customer, a single product. Anytime you're dependent on one thing or even just a couple of things, it's going to obviously put you at more risk. Same way with a single supplier, because if something happens with that supplier, it's going to disrupt your supplies. What percentage of the company's business comes from overseas? It's nice if you can diversify into other markets. Are there legal and regulatory issues that you might have to deal with? Some industries, that's a really big deal, and so it increases the risk of those companies. What you definitely want to do is research the industry and try to determine what's the growth of the industry, and then how does this firm match up to that. So what's the sales growth for the last few years? What is the trend for the future? What's the expected trend? And then how does the company that you're analyzing compare to that? You would hope that it would be at least as good as the industry or better, but you'll have to see. So then there's your company's sales growth. Is it declining or is it increasing? And if so, in either direction, why is it declining or increasing? If it's increasing, can we invest more to continue that increase long into the future? If it's declining, what can we do to turn that around? And is the decline or the increase consistent with what's happening in the industry? Now here what I did was give you some ideas for revenue analysis. There are a bunch of different reasons you can have declining revenues, and this is just some. And you'll notice that when I go through these different reasons for revenue analysis and revenue growth, and later on gross margin changes and so on and so forth, some of these will apply to corporations and some will apply to small businesses. So I just kind of mixed them all in because you could be analyzing a small business. Given that information isn't publicly available, it's likely it's probably a business that you work for or that you are the owner of. But with the revenue analysis, if you do have declining revenues, you want to identify the reasons, and here are some possibilities. These are just things to give you something to think about. Maybe there's a price increase that's occurred due to higher cost, and so, for example, if it's a luxury item, then people may cut back on purchasing that because it's not a necessity. Or if there's a lot of competitors in that industry, then people may choose to go to a competitor that's offering a lower price. So pricing is obviously important. Possible that the owner is despondent and he or she's not managing the business properly. That can be true at a corporate level, where you would have a group of management that's not managing properly, or at a single mom and pop type firm where you have one owner that's not managing properly. Increased competition due to the high gross margins could be putting pressure on prices. So it could be that you're making some good money and you've got good profit margins, but when other investors see that, it makes that particular industry attractive to them, so they may come in, and if you don't have barriers of entry, it makes it easier for them to come into that industry, and as a result, the increase in competition will cause you to have to decrease your prices. It's possible that the product becomes obsolete, and so as a result, you're not going to be selling as many. You could have an unanticipated event or natural disaster that could completely interfere with your sales. Recession and, of course, any type of economic downturn tends to have a broad effect on all companies or almost all companies. And this again could apply to an individual store, but construction outside of a company's place for business. I added this one because I know locally that's been an issue for a number of our local firms in the area. And if they can't get to this fast food restaurant because of all the construction that's in the way, or this pharmacy, it's much easier maybe to hit the same fast food restaurant in a different location, or a different fast food restaurant, or a different pharmacy. But that definitely would have an impact on revenues. Increasing revenues. Increasing revenues are generally thought to be a very positive thing. But I do want to point out the fact that there are times when it may not be good. And if you want to pause this for a moment and try to think of some instances where that might occur, I would encourage you to do so. Give it some thought. I will give you an example on the next slide. You may have heard of the case of Vlasic Pickles. This is one of many different types of stories that are all very similar. Vlasic Pickles hired a new executive, and his job was to try to get Vlasic Pickles into Walmart. And there's a great article, by the way, by Fast Company, and Charles Fishman is the author. And so this is where I'm drawing this information. But so as this executive, is looking to try to get into Walmart, now keep in mind, Vlasic Pickles has always, marketed themselves as the superior pickle. so therefore, customers pay a premium for our pickles, which does not match the Walmart business model, correct? So, Walmart is always trying to offer the cheapest thing possible. So Pat Hunn, who was the executive who was brought into Vlasic, talked to Walmart, and they brainstormed, and Walmart finally said, I tell you what, we will carry your brand of pickles, and the margins were in the sliced pickles, and we'll carry your entire brand of pickles as long as you will also offer the gallon-sized jar of whole pickles for Walmart exclusively. And so Vlasic agreed to that. And so what happened was they offered gallon-sized jars of whole pickles, and if you think about that, those jars weighed 12 pounds. I don't know if you ever remember seeing them on the end caps at Walmart, but it was a huge draw for Walmart. And their customers really liked it. Walmart priced those gallon pickles at $2.97. And technically, that is more than a year's supply of pickles for most people, for less than $3. So, as mentioned before, the pickle maker had spent so much time convincing customers that they should pay a premium for their brand because they've got premium pickles. But now Walmart was practically giving them away. And so it caused a buying spree that impacted Vlasic Pickles dramatically. Now, the upside was their revenues went up dramatically as a result of this. But the problem lies in the fact that the margins were so low on these gallon jar pickles. Walmart just made a penny or two for every gallon they sold, and Vlasic just made a penny for every gallon sold. So it was what this writer calls, I love this term, a devastating success. It was very successful, increased the revenues, but it was devastating to Vlasic. Now, how is this increase in revenue so devastating to Vlasic? Well, they went into every Walmart store, and at the time there were over 3,000 Walmart stores. So if you do the math, and you figure that each Walmart store was selling 80 jars a week, that's 240,000 gallon of pickles in gallon jars that Walmart sold every week. So that is whole fields of cucumbers going out Walmart's doors. So what Vlasic found out the hard way is that Walmart's business started cannibalizing their business in other stores, Vlasic's business in other stores. So instead of going to another grocery store and buying the Vlasic pickles where they usually did, where they usually do their shopping, they would actually wait till they got to Walmart or go to Walmart and pick up the gallon jar of pickles. And so they started losing sales on their higher margin products because of the gallon jars. So Walmart was making out like a bandit on this, and Vlasic was hurting more and more. And over time, what we find, and we violate that rule of 10 to 15% that I mentioned earlier, 30% of Vlasic's business was dependent on Walmart. But the company's profits shriveled 25% or more, maybe a little bit over that. So Vlasic went to Walmart and begged for relief. And Walmart was like, no way. And basically said, we'll increase the price. If you just give us $3.49 for a jar of pickles, that would help us tremendously. And Walmart came back and said, if you do that, then we'll stop buying all your other products. And we'll find someone who's willing to work with us. So Vlasic was kind of stuck there. And so there you see the bargaining power of the buyer when you've got a powerful buyer, or a buyer that buys a large proportion of your goods. So they literally waited till Vlasic was in financial distress. And when Vlasic went into financial distress, Walmart did come back and said, basically, we've done to pickles what we did to orange juice. There's a similar story there with orange juice. And it says, we've killed it. So they backed off. And they went ahead and let them raise the price for, well, they let them decrease the size of the jar, I should say. So in effect, it was a raise the price. So instead of $2.97 for a gallon of pickles, it was now $2.79 for a half gallon of pickles. But it was giving a little too late because that, with some other problems that Vlasic was experiencing, but this was an important factor, obviously. Vlasic ended up filing for bankruptcy. They did come out of bankruptcy eventually, but this is a good lesson in many ways, in the sense that increasing revenues is not good if you're not making the margins. And so you've got to make sure that you're still making good margins if you have increasing sales. So you want to check that out. And that's a really common problem for high growth companies, is it's real easy to lose control of cost and then your margins deteriorate. And then, here we see a prime example of why you don't want to be dependent on one customer. Okay, so I kind of mentioned this already. You want to strategically increase revenues with good gross margins, and gross margins are going to vary by industry, right? You've got some industries that are extremely competitive, and so their gross margins being defined as revenues minus cost of goods sold equals gross margin. So some industries are going to have much higher gross margins than others. So you have to kind of see what's typical for that industry and judge from there how well your company is doing. So what are some possible reasons for declining gross margins? Well, I can run through a few of these. Again, these are just some examples. There's many others out there. There could have been a change in the product mix that's being sold. Okay, so if you have declining gross margins, maybe you're selling more of your lower margin products and less of your higher margin products. And obviously the solution to this would be trying to push more higher margin products out there. It's possible that your cost of supplies may have gone up. And if your cost of supplies go up, ideally you want to increase your price as well, but that's not always an option, especially if the industry is very competitive. So you have to kind of check that out. The company might be buying from different suppliers at higher cost or selling to different customers at lower prices. And so again, we're looking at different ways that cost and price might change. And then you also have to look to see if some of these changes are occurring because of a change in accounting rules. That would be disclosed in the financial notes, and that's less concerning. So they could have changed their accounting system. In this case, if it was a mom and pop store, from a cash system to an accrual system, but then for corporations, they may have changed the way they record revenues or the way they record cost, the way they price or value inventory. Any of those things can have an impact on gross margins, and so you'd want to take a look and see if there were any changes there. How would you increase gross margins? Well, there's lots of different ways to increase your gross margins. And again, here's some examples. Cut labor cost. And many corporations have done this. So you train the workforce so that they become more productive. Reduce the workforce, have fewer employees, and try to find ways for them to work more efficiently. Reduce employee absenteeism, which often results in increased labor cost due to overtime pay for your other employees. Increase productivity by using technology. That's probably one of the more popular ways we see gross margins increasing these days. And increase volume so that the cost per item produced goes down. So in other words, what you're looking for is economies of scale. And that's easier said than done, but if you're able to do that, that's certainly a way to increase gross margins. Other ways to cut labor: find cheaper labor. Again, companies have done this for decades, moving operations to countries where labor is very cheap, like China and India. And there's even places within the United States, like in the South particularly, where labor is much cheaper. Provide workers with stock options and other incentives in lieu of higher salaries. And also it tends to make those workers more vested in making sure that the company does well. For jobs that require less training or where there might be a large supply, consider buyouts for higher paid employees and replace them with newer or cheaper workers. We see companies doing that a lot of times. The most recent example I'm thinking of is it isn't a company, but some school districts have been doing that, where they've been buying out teachers that have been, have 20 years experience, and over the 20 years have accumulated quite a high, or not a high salary, but they're paid more than the new teachers coming in. And so they buy the more expensive teachers out, and then in exchange hire new teachers at significantly lower salaries. And then that helps the schools balance their budget better. So the corporations can do the same thing. Implement good management skills. Okay, and so that one's a pretty obvious one. You can reduce your material cost. This would work, well, really it could work for any type of firm, whether it's a manufacturing firm or a merchandising firm. Merchandising firm is you'd want to reduce your inventory cost. And even a service-oriented firm, you can reduce your cost by trying to use fewer workers so you don't have as many people on salary if that's possible. But other ways is to obtain competitive bids from suppliers and purchase materials at the lowest possible cost. Try to buy at higher volumes, and in that way you might get volume discounts. Outsourcing is another way to do that as well. Outsource maybe some of your production to other companies, and then if there's an economic downturn, you're not stuck, paying these individuals. Now, it's risky for the companies that are taking the outsourcing because they know that if there's an economic downturn, they're probably going to lose the business. But that's one way corporations will structure themselves to try to help themselves get through recessions and economic downturns. And then if there's substitute material that you can use, ideally you want to make sure that the quality doesn't deteriorate as a result, but if you can offer the same product in terms of quality with substitute material, that could help as well. Manage waste. A lot of production manufacturing companies have worked to try to reduce the amount of material wasted, as they're producing their items, and that has helped a lot to increase their margins. Do quality control checks very frequently, so that way you're not throwing out a whole lot of bad items. If you're doing quality control too far down the manufacturing line, and let the most experienced and trained people perform the more detail-oriented or labor-intensive work. So, can you raise prices? This isn't easy for a lot of firms. If it's very competitive, the answer is going to be no. Sunbeam's a great example of that. Back in the day, the small appliance industry went under because they were in an extremely competitive position because you had so many players in that market. Black & Decker, GE had been in that market, but they actually exited before things got too bad because they saw it coming. So that's good management. And Sunbeam had other things going on too. But if it's a very competitive market, then you're not going to be able to raise your price. But if not, then that's a consideration. Price elasticity, you have to kind of consider how much are consumers willing to tolerate in terms of a price increase before they switch to another product or just go without. We always use the movie theater popcorn as an example. We pay astronomical prices for popcorn. Their margins are so high on their popcorn sales, and it looks to be that those prices can be raised, pretty high before people will stop buying popcorn. And so movie houses, movie theaters, have taken advantage of that for years, and that's where they get actually most of their gross margins is from the sales of concessions during movies. Substitutes. If there's substitutes available at a more competitive cost, then you're going to have a harder time raising your prices. So you're going to have to look at perhaps reducing cost, or cost reductions can be detrimental, to the product. So again, the quality of the product, so you got to be careful about that. Or is there some higher margin product you can begin offering? So start looking at the introduction of new products. So net profit margins, that differs from gross margins in the sense that now with net profit margins, you want to go down. This is down after all expenses are considered, how much is left. So for example, if a net profit margin is 5%, that means for every dollar of sales, you have a nickel left over, 5% left over as profit after all your expenses are covered. So net margins are going to vary considerably by industry. Grocery stores, for example, have very, very tight net margins. If you look at Costco, is a good example. I mean, their net margins usually hover around 1 to 2%, maybe occasionally gets a little over 2%. So, those types of industries, have very low margins. On the other hand, you look at the financial industry, investment bankers, and insurance companies, that's another one, very high margins. Look at their, pick out a couple of insurance companies and go look at their net profit margins. They're very high. Business Week did a survey and they found that the average net margin for U.S. firms is 5.5%. Now that has a huge standard deviation because you've got some industries where the net profit margin is high as 20-25% and some as low as 1%. So very big standard deviation there. But it was interesting to compare that to the 500 top firms in the world, and you see that the average net profit margin was 3.2%. So in the United States, margins tend to be, or this implies that margins tend to be a little bit higher here. One thing to keep in mind for private companies, they generally are trying to make their books show as little income as possible for tax reasons. Okay, so if you're ever evaluating a private company, remember that their goal is really opposite of a corporation. Corporations want to show the highest net profit possible because that's attractive to shareholders, their owners, and so that's the way you increase the value of the shareholder and you maximize shareholders' wealth and you maximize the firm value. For private companies, it's just the opposite. They have to pay taxes on their earnings, and well, so do corporations, but they don't have shareholders that they have to try to impress. So in order to minimize their tax liability, they try to make their earnings as low as possible in the book. So whatever they can do to make it lower helps them manage their tax liability. So just keep that in mind, if you're ever evaluating a private company. As I mentioned before, the management discussion and analysis is very helpful. It will give you some of the information that I've reported here. It'll tell you what changes in revenue components have occurred in the past year, and it may forecast what they expect in the future. It discloses uncertainties affecting or likely to affect their revenues. So again, that's forward-looking. And they also give the historical view as well. They report on growth in revenues to prices, volume, inflation, or new product introductions. They also report, like I said, just other forward information. So very helpful, management discussion and analysis, MDA for short. It's interesting to look at, now I'm kind of going back to the numbers now, but I'm just talking about them qualitatively rather than getting into the ratios themselves. Different users of financial information will emphasize certain ratios, and this comes from a number of different studies, and I thought it was really interesting to take some major users of financial ratios like banks, and then corporate controllers that manage your corporations, CPAs, certified public accountants, and chartered financial analysts, CFAs, who, your CFAs analyze securities, and see what types of financial ratios they tend to emphasize. So it's kind of interesting to take a look at that. So your commercial loan departments, now keep in mind each of these ratios were rated on a scale of 1 to 10, with 10 being most important and 1 being least important. So as you might expect, for commercial loan departments, if you look over in the primary measure column, the right-hand column, they're going to be really concerned with how much debt you already have. So how leveraged are you already? So they're going to be concerned with that. If you'll notice, roughly half the ratios are, measure fixed cost or debt. They're going to be concerned about liquidity. So how liquid are you? How are you going to be able to pay your loan payments? And profitability is going to be another consideration, because profitability is going to impact liquidity. So interesting to look, debt being primary, then liquidity, then profitability. Another aspect of banks is it's interesting to see what ratios appear most frequently in loan agreements. And again, notice that debt dominates. So, how much debt do you have outstanding? They might limit the amount of additional debt that you can take on. Notice liquidity is in here as well, but not emphasized nearly as much. Here, the measures are the percentage of banks with these ratios in their loan agreement. So, notice that 92.5% have the debt to equity ratio as a primary measure of debt, and 90% of the firms use the current ratio as a liquidity ratio. And then you see the percentages get a little bit smaller from there. The asterisks are ratios that don't really fit into the profitability, liquidity, leverage, or activity ratios. Usually a lot of times their market ratios are just other information. So the dividend payout ratio, what percentage of earnings are they paying out in the form of dividends? That's going to be important, and for banks, because they don't want them paying out too much in dividends when they have this leverage. And so they will certainly limit the amount of dividends that can be paid. And so that's why you see the asterisk there. It doesn't really fit into the other categories. It's really referred to more as a market ratio. Now, corporate controllers, so this is part of your executive suite, and they're managing the company, and look at the emphasis. The emphasis is on profitability, which makes total sense because they're trying to keep the shareholders happy. So profitability makes up 6 of the ratios that dominate here. They do look at debt, right? They don't want to become overly leveraged, because obviously the risk there is you become overly leveraged, and if you can't make your interest payments, you can be forced into bankruptcy. You see other, again, other is really your market ratios. So again, that dividend payout ratio, and then your price earnings ratio, which is an indicator of customer confidence, or I'm sorry, shareholder confidence in the company. So the higher that is, the better. And then there's one little liquidity ratio down there at the bottom, the current ratio. So corporate controllers absolutely focused on profitability. So, different than what we see with bankers. What ratios appear in the corporate objectives? And so, again, we're looking at percentages. So in the corporate objectives, earnings per share, so again, profitability shows up in 80% of corporate objectives. Again, they give a nod to debt as well, and liquidity, but the focus, as you can see, is profitability. CPAs also tend to emphasize profitability, but liquidity as well. Okay, so CPAs are really concerned about, do you have enough cash on hand to pay your bills? So if you look, it's actually the top concern, and then profitability falls down below, and just a little bit with debt. So, again, your bankers are looking at how leveraged you are, and your liquidity. Your management, your controllers of the corporation, profitability, and then your CPAs, liquidity and profitability. And then finally, our chartered financial analysts, the ones that analyze our securities. Again, as you might expect, they're going to be very focused on profitability. They do look at debt to see how leveraged the company is, but profitability definitely dominates. Notice among the market ratios that are out there, they do very much emphasize the price-earnings ratio. Like I said, that price-earnings ratio is considered to be one of the most important market ratios because, again, it represents shareholders' confidence in that company. So the higher that number, the more confidence the shareholders have in the future earnings of that company. And then this is just a breakdown so you can kind of see the comparisons. So again, loan, departments, debt, and equity ranks most important. Corporate controllers is earnings per share, so kind of the market ratio there. CPAs, liquidity, and CFAs, return on equity after taxes, was like number one. And you can see the green are your debt ratios, the light blue is your liquidity ratios, orange being profitability ratios. So across the board, they're all interested in profitability, but CFAs and corporate controllers definitely dominate that area. And then there's a little bit deeper blue that's other. Okay, financial ratios that you are likely to find in annual reports. This is important because annual reports do tend to kind of focus on many of the same types of ratios, and also this shows where you can likely find them. So earnings per share is reported in every annual report, and in the sample that was included here, it was included in 100% of the reports. Most of the time it's reported in the president's letter and in the management highlights and in the financial summary. So in other words, it's reported in more than one place. Management discussion and analysis might have it, financial review might have it, but you're not going to have any trouble finding earnings per share in the annual report. Dividends per share showed up in 98 out of 100 annual reports, so 98% of them, and again tends to show up multiple times in the president's letter, management highlights, and financial summary. The book value per share, which represents the original selling price of the stock, shows up very often, 84% of the time, and there you can see tends to be emphasized in management highlights and financial summary. Working capital, which is your current assets minus your current liabilities, which is a measure of liquidity, shows up at 81%, and usually again in management highlights in financial summary. If you'll notice, management highlights and financial summary tend to report many of the same numbers, and then as you move on down the line, you don't see these offered in as many of the annual reports, but still in over half we have return on equity. The profit margin, that surprised me because I figured the profit margin would be reported in more, probably more likely to be reported in those that have very high profit margins as opposed to those that have lower profit margins. And the effective tax rate is reported in about half the annual reports. And that's the effective tax rate is what I use as a measure of transparency, because the taxes that they actually show that they pay in their income statement oftentimes is not the real amount of taxes that they pay. And that's a larger discussion, but it has to do with the fact that they can use different depreciation methods for their annual report than they do for in-house. And so in-house, if they use accelerated depreciation methods and they pay taxes according to their in-house earnings, their tax liability may actually be much lower than what was shown on the income statement. So I like to look at the financial notes and see if they disclose the taxes that they actually paid or what their effective tax rate was. And if they report that, that to me is a level of transparency that I appreciate. So, as we kind of conclude this section, you might want some data, look for some financial data. Obviously, you can crunch numbers for yourself, but probably the most well-known source of financial data is Dun & Bradstreet, D&B, and there you can see what all, the different type of information they have. Unfortunately, you do have to purchase that. So, if you're not wanting to purchase financial data, then we have other sources we can look at as well. But this is a great source of information. If you have to do an analysis and you can get your employer to pay for it, that's great. Risk Management Association, they also have some data. And so, again, you can see what they report there, or the type of data they have there, but that's available as well. Other sources are the annual reports, 10K reports. You might be asking, okay, what's the difference between a 10K report and an annual report? Your 10K report are all the financials and the letters and stuff that are submitted to the Securities and Exchange Commission. The annual report adds to the 10K report and gives you the glossy pictures and some other information about the company. But it has the same financial information in it as the 10K report. Trade journals, meaning journals within the industry of the company that you're examining, that's a great source of information about the industry in particular. So I would take a look at that. There's also other computerized data sources such as CompuStat's an example of one. It's not the only one out there. It's probably the most popular, but it's also one of the most expensive. A nearby university may have access to that or may be able to give you access to that if you want to look it up, but it has financial information for thousands of firms over at least a 20-year period, if not longer. And then there's newspaper publications and online portals that are very helpful. You can't really tell here, but I bolded Wall Street Journal. For financial information, Wall Street Journal is great. Wall Street Journal also does great investigative reporting in the financial arena. I also like New York Times, Financial Times, Investors Business Daily. And then you see three websites, The Street, Smart Money, and my favorite, Finance Yahoo. Finance Yahoo's free. All three of those websites are free, but Finance Yahoo is free, and there's just really a ton of information that you can find there, and it will also give you, recent sources you can look up of articles that have talked about the company that you are looking up. If you're looking for competitors, you can find it there as well. So hopefully this gave you some information on what to think about in addition to the numbers when you're analyzing a company. And thank you for listening. Bye-bye.